Well, hello and welcome to another episode of the Lending Podcast here in Austin, Texas. We are your hosts. I'm John Burnam, along with Jeff Jones.
Hello.
It's good to be with you again today. Yeah, you were going to say
We're going to say it's Jinx.
Jinx. All right. Well, we are excited to bring you a topic today that we're getting a lot of questions on.
A lot, actually.
And I love what you said before the show. You said every buyer at some point will become a seller.
Yeah.
And so the topic really is about how do we make this market, this interest rate environment, the discussions that are happening, how do we make the payments more affordable? How do we make the payments more appealing? How do we make the homes more appealing so that buyers get off the fence and want to buy? So some strategies for sellers to make their house more appealing.
Yeah.
That's kind of the...
It's good. You know, I have a couple hundred people in my past client database. You have a couple thousand people in your past client database. Doing it a lot longer than me.
Right.
But, you know, we like to keep in touch. I can't talk right today, but we like to keep in touch with people that we've, helped out with home ownership. And, we've been hearing a lot of similar things. I'm thinking of selling my house. Do you have any pointers for me? What do I need to know? And it's almost a reverse consultation of what we're used to, of like, here's some great opportunities to consider when you're selling your house. From my perspective as a lender, seller concessions instead of, if you have to get to a point where you think that your house is sitting too long and you're thinking of a price reduction, consider what seller concessions can do compared to a price reduction and maybe advertise that. Also, I mean, we operate a little different. We're pretty aggressive with helping our sellers. So we have yard signs we put out as lenders saying, hey, this house comes with lending incentives if you use Benchmark Mortgage and Jeff Jones or John Burnam, and so we have credits that we're putting in. So we're actually assisting in the sale.
Yep.
Out of our own pocket. So
and let's take a little different spin on it. Let's go to market with a splash. Okay.
Yes.
So I'm gonna dive into this
Set
a
yourself
little
apart.
Deeper. Yes.
Right.
So what I've been hearing a lot in the market, and we've talked about interest rates on the show for a year and a half now. We've been in a similar interest rate environment now for about 3 years, since the middle of 2022, and here we are, the middle almost of 2025. And so let's just say, for the sake of argument, the average rates are 7%. Okay, now you can get 6.5, you can get 5 something, you can get 7.5. They're all over the board, but if you Google the average right now, it's 6.97, okay, or something. Let's call it 7%. So the conversations I've had with a lot of my clients, especially sellers, friends of ours, clients of ours that own property that want to buy something else, a lot of them have said, gosh, if rates could just get to like 5.5, 5 to 6, that's going to make it more appealing for them to maybe sell their house that they have a 3% mortgage on. What is that delta? At what point does it encourage a seller to go ahead and sell and buy? And what we've heard is 5.5 is kind of this equilibrium rate where we believe that would be more of a balanced market as far as the buyers and sellers coming together and making more transactions happen. So what if, hypothetically, we had sellers out there that could advertise 5.5% rates on their homes? If that was possible, if you're a buyer out there and you're picking from 2 houses, and this house you're going to have a 7% rate on, and this other house, very similar amenities and price point, you can get a 5.5% rate on. And I'm generalizing, but this is possible. How much more appealing would that 5.5% rate be? Now, we don't know how much more appealing it would be until we see the payment. And that's what all this is about right now, is there's some payment shock out there with a lot of our clients because insurance costs have gone up and taxes have gone up. And everything else has too. Your cell phone bill, we get it, all the things, groceries. If that 5.5% rate were a possibility on this house versus that house, what does that do to your payment? And let's just run some quick math. On a $400,000 house, that 1.5% differential in interest rate is $500 a month.
That's some serious reality right
That's
there.
a car payment, a healthy car payment.
Yeah.
And so as a seller, we're educating our listing agents and really would love to have more conversations with sellers out there, whether they're going to be our client or not, about, hey, you can advertise instead of a price reduction or price improvement, as I keep seeing, instead of a price improvement, offer enough seller concessions, you touched on in the beginning, seller paid closing costs, use that seller paid closing costs to buy down the interest rate for the buyer, and therefore you've got the new normal is now an interest rate below 6%, which we believe through conversations with a lot of our clients would get more buyers off the fence.
Yes, I love it. I think that is the right thinking. Here's a concept I want to put in people's ponder pots.
Ponder pots.
You know, put yourself if you're trying to sell the property, you want to think, what is that buyer that's coming to my house going to think of my house? And a lot of times that has to do with like how it's staged, how it looks, curb appeal. But it's a lost art of how well will their financing options be? Can they get into 5.5s? So I think a lot of people understand that as a first-time home buyer, they might have not as much cash reserves as previous buyers in the history that have been move-up buyers because it's their first home. And they might also have a little bit, restriction on buying power, and they might be stretching to get to your house, of their max purchase price. So financing is tough for a lot of people right now. And if you can come in with those options at, like, let's say new builds, why is it so enticing for a first-time home buyer to go to a new build? It's because they're giving tons of concessions, they're buying down the rate for them.
Yes.
People don't realize, put this in the ponder pot, you can do that too privately if you have good lender relationships. So what if you go back to your lender that you used to buy your house, and if they're still in business, and you ask them, hey, would you be willing to help me advertise that you can provide lending incentives on this property if they use you? If my past clients ask me that, the answer is always yes. I actually already have yard signs printed for this. I could put them in the yard today. And it's going to have just basically this property comes with lending incentives if you choose it. So it's super general. Some of them are really specific. You can have flyers for your open house that has those payment scenarios on it, specifically for your house.
Yep.
And those are really good too, because you can get a little bit more granular of what a monthly payment looks like, what a rate, cash to close, because it's address specific. So if you can get a lending partner, just like a new build has, to entice more clients, and you do that from the start, not like, hey, let's try it without that for a month. Well, you miss all those people that are really interested in your house that have looked with no incentives. But now, if you start with incentives out of the gate,
Yes.
you are ready to rock and roll.
I think it could be a way different picture. You go to market with the lending incentives. You have a sign in your yard. You have that first open house that weekend. You spray the neighborhood with the flyers. Your agent could go out and even do some door knocking. Door knocking's coming back. Let me just tell you. And it's really about finding out in the neighborhood, who else might be interested, right, in your property, and letting your neighbors know, hey, we're going to have an open house. Who do you know that maybe wanting to move into the neighborhood? This house has some incredible lending incentives. And this really came from a conversation I had yesterday with one of my agents. This has been brewing for a while.
Yeah.
And one of my agent partners called me, a good friend of mine, and he said, I've got 4 listings right now, and the showings just aren't there. The houses are staged. We've done videos. What can we do? What are some ideas? And we were brainstorming together. And I said, well, this concept of advertising lower interest rates on this house specifically, because the seller is going to contribute towards the buyer's rate buy down, and the lender we can contribute to that as well. And we were talking about it. He said, okay, I like that idea. That may work. He said, but one of my sellers, it's super tight on the numbers because they just bought the house 16 months ago. They don't have that appreciation that a lot of folks have had if they've had their house for 5 or 10 years, right? And so they're basically selling it for what they bought it for, and they're going to kind of take a little bit of a loss. But my conversation with him was, how much is the payment every month? They've already moved. If they're making a $3,000 a month payment, and they keep the house for 6 more months, that's $20,000. It's a slow burn to $20,000, but you're still spending $20,000 versus let's spend 10 today or 12 or 15 or whatever,
get it off the books,
to promote it and get it off the books. And unfortunately, we got to take that loss if the folks can do that. So it's some harder conversations, but I think our sellers having the conversation with their lender, if they don't have a relationship, find a lender through their agent, we're open to having the conversation. I told my buddy yesterday, I said, whether we're doing the loan for them on their next property or not, and in this case, they were going to move out of state, so we're probably not going to help them on that next mortgage. That doesn't matter. We're in the business of helping our agents sell homes, our clients sell homes, and helping homeowners get into properties. And so this concept of the lending incentives really does rival the new build model, where the new builds, they hit the market with the incentives. Our sellers should be considering this right now. Hit the market with the incentives
Compete
to set
against
yourself
the new build pricing
apart.
structure.
Yeah.
Because you can do it, and people don't think they can do it, but you can. You just need a good lending partner.
That's right. And these are what we're kind of talking about too is permanent interest rate buy downs, right? So if you're a buyer and you're thinking about, okay, 7% just sounds high. My payment for my $400,000 house that I want to buy, the payment's just a little too high for me. If it was $400, $500, $600 a month cheaper, I might consider it. And that's what we're talking about. Is this is a permanent interest rate reduction. There are some temporary rate reduction options, and sometimes those can be done in conjunction with the permanent buy down. But we're talking about getting a 5.5% interest rate for the next 30 years. And what's intriguing about that is the more conversations I have, as optimistic as we are that rates will come down to some degree, right? They're going to come down some. They have at times come down, then they'll spike back up. And a lot of it's economic data and what's happening with unemployment and what's happening with jobless claims and all those different reports and how the bond market responds, the markets respond to this economic data. But what if rates really don't come down below 6.5% or 6% over the next 3 to 5 years?
Are you saying that the last 3 years might continue?
If the last 3 years continues, but you get into a home at 5.5%, then you're not banking on that refinance. I think a lot of folks were maybe banking on the refinance the last few years, and it hasn't been there.
I think there's been a lot of that. I think people have been telling people the pie in the sky, hopeful information of rates are going to go down, rates are going to go down. As you've probably heard from us over the last year, there's no evidence of that yet until we see a couple big markers that we haven't seen. And we're still not seeing them, to be honest with you.
Nope.
So I'm not seeing much change until big announcements can change things. All I'd say is I like what you're saying. I think that, for people out there that are listening, yes, you too can compete against incentives that builders are throwing out there for new builds as a seller on your own existing property. Just need a good lender to help you, framework that.
That's right.
Show those payments on a nice piece of paper that has like a flyer on it. Advertise it maybe with yard signs. That will work, and that will be a huge buzz as long as you're real. We're not realtors, so we don't want to pretend that we're going to say something better than a realtor, but we know the market too. We're in the business. If your realtor is getting good exposure on the right listing databases, if it looks staged well, great photos,
priced well, and you're not getting the traction you thought you should, and your realtor, as far as you know, is doing everything right, then it just might be priced wrong. Because in reality, it's an emotional thing. Somebody that's sitting on a property for just has it for 16 months, they need to make their money back. It's emotional. But instead of taking a $20,000 loss over 6 months, sell it now with a $10,000 credit. You're up $10,000 from if you forecast that out 6 months. So taking the emotional piece out of it by having professionals around you to walk you through that is huge, because it's hard for me if I have to sell my house at a loss, to actually swallow that pill. But the reality is you're swallowing it no matter what. Right. And just get it done. And a house is only worth what somebody's willing to pay. Yep. And we're seeing, unfortunately, we're seeing this and having this conversation on houses that are priced well. Like they're staged well, they're priced well, and they're still not or whether they're staged or not, but they're priced well, and they may not be moving. And that's a combination of several factors. First of all, it is the beginning of summer. School just got out. There's some market timing that's important. But it is summer, which is the buying season typically. So this time of year should be busier historically.
Should be.
And we have seen things pick up. It's actually been pretty darn busy the last few months relative to this time last year. In 2024 was definitely slower. So we've seen things pick up. However, the articles you read, Inventory is at a high since 2019, right? We
Yeah.
have more homes on the market, or as many homes as we had in 2019.
Right.
And then what happened in 2020 and 2021 is obviously we had COVID and we had mass demand, and then the market went bonkers. So we could be poised for an uptick in demand with some of these types of tools, a little bit of help maybe from the interest rate markets, yes, but we can get to that 5.8 or 5.5 or 5.9 rate now. And I think the other day I was having my same loan consultation that I have with all my clients, and we were looking at the rate sheet. Okay, so a rate sheet, the way lenders display rates
Ooh,
is
here's a look behind the curtain.
look
I like
behind
it.
the curtain, which I love to do. And I think my clients were they're like, wow, I didn't know that there were this many rate options. Interest rates right now start at about 3.99. You can get a 3.99 rate. Now, it might cost you, depending on the loan size, $40,000, $50,000, $60,000, right, to buy that rate down. How do the builders do it? The builders do it because they do something called a forward commitment, and they're essentially pre-purchasing discounted rate options in bulk from Fannie Mae or Ginnie Mae or Freddie Mac, which is the big buyers of all the mortgages out there. They're pre-purchasing these loans in bulk, hundreds of millions of dollars at a time. Maybe not that much, but big numbers. And so as a buyer of a new build, you walk in and they say, we have a rate at 3.99%. How are they doing that? Well, they've pre-purchased that loan, and they've probably forked over the $40,000 to $50,000 to buy, but they have the purchase power in volume. So you're essentially financing that buy down in the cost of the home. There's no other way around it, right? And so as a buyer that's not buying a new build, if you're buying a resale home, the seller is kind of like the builder. They can pre-purchase that loan rate at a discount through seller concessions, right? And so the seller concessions and seller paid closing costs go to the buyer. We lock the loan at a discounted rate. We take that money from the seller and we buy the rate down. And when I showed my clients the rate sheet, they said, wow, I didn't realize you could get a 4% rate today. So yeah, you can get a 3.99, you can get 4.99, 5.99, it goes all the way up to 8, 9%, right? The higher the rate, the lower the cost, the lower the rate, the higher the cost. So how do we package this up and get that message out to more folks that really is a strategy that as a buyer, you get into the home that you're excited about, you get a payment that you're excited about, and you get a fixed interest rate that's well below the market that most likely you may never have to refinance or get to refinance, because the likelihood of rates going below 5.5 or 5 again in the near future is pretty slim.
Yeah.
It could happen. We'd need some major something, COVID 2.0, I don't know what would happen, but something major would have to happen, right? Something global probably, to drive those yields, those bond yields down and interest rates down. But barring something major, just normal course of activity over the next few years, we're probably going to be in a pretty stable interest rate environment for a while. So Why not use this tool, the tools that we have that a lot of folks don't know about, and let's get those rates down in the 5s for our buyers and help that affordability.
Yeah, I like that. I mean, you and I favor permanent buy downs just because of the nature of our current environment. Mm-hmm. There was a season where temporary buy downs were hot because there was a lot of wrong forecast models that were promising lower rates at the end of fourth quarter last year. And so early last year, 15 months ago, temporary buy downs were hot. And a lot of people were advertising them. A lot of new builds were advertising them. Mm-hmm. It's when you saw that 3%, a rate that started with a 3 or 4%. And what they were doing was the little asterisk at the bottom, that program was an FHA loan, which allowed a 6% concession, because FHA on that structure was a 6% concession allowance, whereas conventional with only 3% down is a 3% concession. There's a whole structure to those concessions. But they're allowing max concessions on an FHA. They're buying down the rate permanently into the 6s usually, and then they're doing a 3-2-1 buy down on top of it, which would drop it 3 interest rate points for the first year, 2 interest rate point reduction for this next year, 1 interest rate point for the last year. And that is available too. Yeah. And they were advertising that in huge letters. There's advertising laws where that was illegal because it has to be the same size as the APR. Anyway, all that good stuff. But that is also available.
Yep.
You know, so it's like you can have a lending professional have a simple one-page flyer that shows here's your pricing option without concessions, here's your pricing option with a permanent buy down, here's your pricing option with a temporary buy down, and let the buyer talk to the lender to see which one fits perfect. And that is amazing because then they'll see what their monthly payment is, cash to close, and you're competing against new builds.
Yep, that's true. And we did an episode on the temporary buy downs. It's a great program. It has its place. It's just right now, with the conversations we're having and this general consensus that, wow, the market would sort of get unstuck if we could get into the fives. If rates were in the fives, you know, then everybody will be happy. We'll be moving and we'll be buying property again. And maybe that's the case. Maybe it's not. But I will say this. We touched on those numbers. A 5.5% rate versus a 7% rate. You're saving $400, $500, $600 a month. And even at a bigger price point, that might be closer to $1,000 a month on, you know, a $700,000 or $800,000 house with that kind of interest rate differential. And that becomes the affordability discussion is way different at that point. And you've got a lot of buyers out there that I think would jump at that. They just don't know the options are there, because if you Google the rates, that it says 7%, and then that's like, oh, this should have 7%. And back to the example of showing my client all those rate options, and they said, wow, I had no idea. I mean, we had a half a dozen lenders in each rate category with different costs per rate, like a 6.25 with 6 different lenders that were shopping. And so I think it was very eye-opening. I know it was very eye-opening for them. And that's just scratching the surface from an educational standpoint. The message we're working diligently to get out to our buyers and our referral partners and our, you know, even financial advisors, CPAs, business professionals out there. 7% does not have to be your rate. You've got 30 options, right? And it takes some strategy sessions. It takes collaboration and open-mindedness on the seller side. Yes, and we know it may feel like we're getting into your pocket. We're not trying to, if you're a seller out there, get into that equity. We want you to capture as much of that equity as you can. At the same time, what is your payment per month? What is your bleed out rate, right, at $3,000 or $4,000 a month, and property taxes and insurance, all those things, and the risk of a home just sitting vacant, because a lot of our sellers have already moved on. And if you're living somewhere else, you've got a vacant house, and I have rental property, I know there's a little just, you know, voice on my shoulder about like, oh, hope the house is okay, you know, hope nothing's going on with this vacant house when there's no one there, because really nothing good happens to an empty house. So we want to get those properties moved, and this is a couple strategies to do that.
Yeah, I like it. I like that you said, you know, start your listing with a splash. Become the coolest kid on the block.
Right.
You know, for that house, you know, your house is way cooler because it's coming with way more incentives. Right. I mean, and here's the thing you can ask, you know, your realtor too is, even if we price this lower than a new build, say there was a new build across the street. If I price below new build, are they going to pick me, or are they going to pick the new build? Because their monthly payment with the new build might be cheaper than their monthly payment with your home, which is priced lower because of the incentives and the rate buy down. Yeah. And so that's one way to think of it, is it's not so much reducing your price correctly, it's making that monthly payment more palatable for your buyer that's coming into that home. I love that.
And for our buyers out there, presenting this to a seller and our buyers agents out there, when you're structuring your offer, it really should be buyer's agent, buyer, lender. We're like a tripod. We're all three of us are communicating on how to structure this offer to a seller and presenting it to a seller in a way that says, hey, we have several homes that we like. We really want to buy yours, and this is what it's going to take to get there. And this is why we need $20,000 in closing costs paid for. It's not because the buyer doesn't have the money. It's because in some cases the buyer can't buy down their own interest rate. You know, you can buy a permanent buy down yourself as a buyer, but you can't do a temporary buy down with your own money. It has to come from a seller or an interested party contribution. So there's presenting that to a seller where it, obviously you may offend some people, right, with your offers. That's not the intention, but sellers can get offended if offers come in low. But if presented correctly, it's here's what's going to allow us to buy your home.
Right.
We need a payment that's X, and this helps us get to that payment because the seller concessions help us with the buy down. Our lender's also helping, and we're collaborating, and seller and buyer come together and make a deal.
Right.
And I think that open-mindedness, I would encourage our sellers out there to be open-minded to this concept, encourage the buyers and buyers agents to structure it in a way and present it professionally, of course, and communicate to the listing side what our goals are, and try to achieve a win-win out of the transaction. So, thanks for.
I like what we covered.
Yeah,
it's good.
Thanks for collaborating on this topic ahead of time, and then it was kind of hot off the press yesterday with the phone call. It's funny, a lot of our episodes literally come from, I had this conversation yesterday, and then ... and then there's an episode about it. So yeah, we're glad you're with us, and welcome your feedback and anything we can help you with.
Yeah, and on that note, give us a comment of what you want to hear from us. We're answering questions from our clients. If you aren't one of our clients and you want some other answers that we're not addressing, please let us know what those are in the comments below.
Absolutely. All right. We'll see you next time.
Thank you.